If you're making over $200,000 a year, but you're unsure how you can set yourself up to retire early, then this video is for you. High income alone does not guarantee that you can retire early, but if you focus on the 3 things that we'll talk about in this video, you can fast track your way there. So in this video, we'll talk about how to optimize your taxes, savings, and investments to make early retirement a reality. Hey everyone, my name is Jake Skellhorn. If we haven't met, I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My YouTube channel here and my firm are both dedicated to giving you more confidence and clarity with your money. So the first thing that comes to mind for me when I work with a high income client who's earning over $200,000 a year is tax efficiency. The more that you can save on taxes, the more you can invest and the more that money will grow for an early retirement. So the first steps that you can take if you're not already to maximize your tax efficiency are utilizing all available tax advantage accounts like 401ks, IRAs, health savings accounts. All of these accounts allow you to deduct income in that high tax bracket that you're in today and ideally be able to withdraw that in a lower tax bracket in the future. Once you've taken advantage of all the pre-tax accounts that you can also look into doing a backdoor Roth IRA, since if you make over $200,000 as a single filer, you're not able to contribute directly to a Roth IRA, but you can do the backdoor method, which I've made other videos on. If you're self-employed making over $200,000 a year, you want to make sure you're working with a good CPA and a good bookkeeper to make sure that you're taking advantage of all available tax deductions and credits available to you, as well as making sure you have retirement accounts set up through your business, whether it be a solo 401k, a SEP IRA, or whatever is most appropriate. As a business owner, you typically have a lot higher contribution limits that you can contribute to these plans compared to someone who's an employee. Beyond the standard tax advantage retirement accounts, a taxable brokerage account is going to be your best friend if you want to retire early, because you can pull money out of these accounts at any time, especially before age 59 and a half, without paying any sort of early withdrawal penalties. We'll talk about investments in just a minute, but in these taxable brokerage accounts, you want to make sure that you're using tax efficient investments, since any dividends and interest is taxed in the year that it's realized. Second thing you want to focus on if you want to set yourself up to retire early is your savings rate. A common rule of thumb is to save at least 15 or 20% of your income towards retirement throughout your career. But if you want to retire early, the truth is that you need to save more than that in most cases. Obviously, this will depend on your unique situation, what your expenses are relative to your income, things like that. But I know plenty of people who are saving 40 or 50% of their income because they want to retire as early as possible. There's a rule of thumb out there that says you should aim to replace about 80% of your current income for traditional retirement planning. But if you're earning, say, $200,000 a year and you only need $80,000 for your expenses, then you really only need to replace about 40% of your income. So this goes back to that relationship between the higher savings rate and a lower income replacement rate. One of the best ways to get in this habit, in my opinion, is to automate as much as you can. So set up recurring transfers to your investment accounts like IRAs, 401ks obviously will have a set contribution amount, but same thing with those taxable brokerage accounts. Again, if you can automate your investment strategy, it's going to make things easier and require less attention from you in the long run. To get a rough estimate of what you might need saved up in order to retire early, take your annual expenses and multiply them by 25 to get the lump sum amount that you would need saved. This is basically the 4% rule in reverse. So if you need $80,000 to live off of comfortably in retirement, times that by 25, that would be about $2 million that you need saved before you can comfortably retire. Once again, this is just a very rough estimate. I do have my own criticisms of the 4% rule, but it's a good way to get a rough idea of what you would need saved. Number 3 is to focus on your investment strategy. If you have high income and you plan to retire early, your investment allocation might need to look a little bit different than someone who's planning to retire at a traditional retirement age. I'm personally a fan of low cost and tax efficient investments like ETFs and mutual funds, and tilting portfolios towards certain factors that can give you higher expected returns over the long run. There's a wealth of award-winning academic research out there that points to why certain companies' stocks perform better than others over time, and essentially what it boils down to is 3 different factors. It's company size, relative price, and profitability of each company. For example, small cap companies tend to outperform large cap companies over long periods of time. Value stocks outperform growth stocks over time, and companies with higher profit margins outperform companies with lower profit margins, no surprise there, over long periods of time. Obviously, this is not going to be the case every single year, so we still have a balanced portfolio in most cases with the clients that I work with, but we tilt our portfolios towards these different factors for those higher expected returns. This is known as factor investing. Leave a comment below if you want me to do a more in-depth video on this style of investing. One last thing to keep in mind when it comes to your investment strategy for an early retirement, is that you're generally going to have a longer time horizon than a traditional retiree. So you want to make sure you're planning for that when you look at your asset allocation. Since inflation will persist even if you retire early, you generally want to keep a good portion of your assets invested in stocks that are expected to outpace that inflation. So in other words, you may need a higher stock allocation than a traditional retiree if you plan to retire early. A couple final thoughts that most people are probably aware of if you've ever thought about retiring early. Number one is try to avoid lifestyle creep if you can. So as you get those raises at work, try to avoid inflating your lifestyle at the same rate. Try to save more of that increased income as opposed to just spending on it. I'm a big believer in balance, living now as well as saving for later. But that lifestyle creep can also take away from those early retirement goals. Also try to limit those fixed living expenses as much as possible. Consider moving to a lower cost of living area if that's going to help out your odds of success in early retirement. And lastly, stay flexible with your early retirement goals. A lot of clients of mine have considered a semi-retirement or the possibility of part-time work, whether it be to just stay active and busy or to provide that little bit of extra income so that you don't have to pull as much from your investment accounts. Hope you enjoyed the video. If you have any questions, leave a comment below. And if you're looking for help setting up an early retirement plan for yourself, feel free to reach out to us at sparkwealthadvisors.com.